Dear students, welcome back to the lecture on Indian economy. When we are talking in terms of economy as such, we need to understand what makes an economy robust or what are the indicators of economy for that matter. Let us try to understand what exactly is we mean to say by indicators of economy. Now, when we are talking in terms of economy per se, we need to understand what exactly are or what makes an economy robust. Or what makes an economy grow, what makes an economy develop, or what factors indicate the health of the economy, right? What factors make the strength of the economy, or what factors determine, you can call it as the indicators determining strength, indicators determining health, indicators determining development, indicators determining growth, indicators determining robustness. So, before we move further towards the indicators of economy, let's talk in terms of the GDP which we are going to discuss here. The most important concept in terms of the whole scenario, the whole fundamentals or the building of economy for that matter rests on the pillars of GDP. This is one area where everything that is related in economy or everything that indicates the robustness, the health, the strength, or whatever indicators are relevant to economy, they all rest on this one single concept, that is GDP. Now, what exactly is GDP? GDP, if you see here in this case, it's a total value of country's economy. Now, when you say total value of country's economy, like we had discussed earlier, it's what? It's total value of goods and services being produced in a country in a year, right? The factor that is more important over here is, here we are talking about in terms of what? Here we are talking in terms of, whatever we are talking in terms of value. Now, why it is more important? The GDP determines the size of economy. We keep on hearing this word whenever we come across that Narendra Modi wants to make this economy a $5 trillion economy. Now, what is that $5 trillion economy? It means the sum total of all the value or the size of an economy is determined by GDP, right? The size of economy is determined by GDP. Now, GDP reflects if the economy is growing or shrinking. If GDP, if it is rising, means economy is growing, obviously. And if it is coming down, that means it's shrinking. In other words, growing, if economy is GDP is growing, that means there is, remember this thing, business cycle. It's on, and growing means it's the economy is moving away from recession. Shrinking means it's coming down to recession. This is growth. So the value of GDP reflects whether economy is growing or shrinking. Also, we keep on hearing that our economies or the growth rate has gone up. Sometimes we keep on hearing the growth rate has come down or it has plateaued. We keep on hearing these words, right? We keep on hearing these words. Now, GDP reflects how fast the economy is growing. If it is growing, how fast it is growing. If it is shrinking, how fast it's shrinking. Which means to say that, now coming back to again the simple definition of what is the GDP, it's total value of goods and services being produced in a country. To put it simple, production is going to be there when there is consumption. Now, consumption is related to what? Distribution. And distribution is related to what? Production. If this is growing because the consumption is growing. Now the consumption is being facilitated by what? Consumption is being facilitated by distribution. Now in distribution, what are the factors that are included? Consumption is growing because incomes are rising, investments are coming, per capita income is growing, Human Development Index is growing. Since all these factors they are growing, this contributes to what? This contributes to growth. Now the rate at which this is growing, or the rate at which these are growing, for that matter, determines the growth rate or the recession rate. If it is growing, what needs to be taken into account? If it is coming down, what are the factors that need to be taken into account? Say for example, if there is growth, that means more and more consumption is happening. More and more consumption is happening means what? Is it irrelevant to the money that is available? If money is equivalent to the value of money is equal to total quantity of consumption, then that is fine. If the money is less and consumption is high, inflation comes in, right? And if the money is more and the goods are less, I think we need to go back again. If the money is more and goods are less, inflation comes in. If the money is less and goods are more, deflation sets in. Now you need to take corrective measures for that. Now how do you measure this whole growth story? Is by consumption, investments, quantum of investments, how much the government is spending. Of course, when the economy is in the growth phase, governments earns revenue by way of taxes, by way of duties, right? All these things, they contribute to what? Government exchequer. And government spends certain amount of money from this. And GDP is also measured by exports. Now, while we are talking all these factors, we need to keep in mind that we might be coming across certain concepts, certain theories, or certain indicators, right? We might be coming across certain indicators wherein we'll be talking a lot about the growth story. Now, what are the indicators? Indicators, if you see, the first indicator which we come across is the trends in GDP, contribution of agriculture, industrial and services. Now, if you come across the first picture over here, which has been taken from Wikipedia, this much, these are the figures that we are talking about, the contribution to GDP. These are the figures. If you see, the combined average of these three is 100. Out of this, maximum contribution is from service sector. Since our economy, since after 1991, that is when the economy opened up, there has been a consistent and persistent shift from agriculture, right? And it has moved from agriculture to services. So our economy is more of service oriented rather than agro based. And coupled with, there has been quite a persistent increase in the contribution of industry. Now, when we talk about these two factors, these two factors, they contribute to what? They contribute to employment. Of which major chunk come from services. Now, industry, there has been a paradigm shift from being an agro-based economy to an industrial economy and service-oriented economy. Industry has grown because there has been investments since we opened up. Right? So if investments are growing, there will be employment, there will be manufacturing. If you see, after 1991, we have started to manufacture a lot of things. And to encourage manufacturing sector, to promote manufacturing sector, government recently in the last budget had come up with PLI schemes. That is productivity linked incentive. It's called as productivity linked incentives to certain sectors of economy. And predominantly, PLI has been given to what? Handset manufacturing industry, specialty steel. Very recently they have given these incentives. That means productivity linked incentive. Whatever we are importing, if you can manufacture over here, depending upon the productivity, right? Capital employed, people employed, depending upon that, you are going to get what? You are going to get incentives. What I'm trying to say is that these are the three sectors which contribute to the GDP. If this sector, for example, if you take industrial sector, Very unfortunately, if you see in the 1950s, we had come up with industries. Of course, this till here, you know, the industrial contribution has only because most of the industries were concentrated in the hands of government. Though the contribution, if you see, it has been contributing to GDP, but it's falling since 1950s. That is from quite first 5-year plans, right? If you see, till 1991. Again, it predominantly dropped down to 14% of the total contribution to GDP in the year 2010. That is a decade back. Decadal studies. These are decadal studies, right? So, meanwhile, sorry, this thing, the agriculture has come down. If you see industry, it has been stagnant. It's been growing. So industry here it is seeing a slight dip because of weak currency. Otherwise, this industry is growing at a consistent pace. Whereas there has been a rapid rise in service sector. So our economy is more importantly relying on service sector for its contributions. So this also indicates that whether the GDP is moving up. If the GDP is moving up, obviously consumption, it reflects that the consumption is moving up, the size is growing up, the economy is growing. Now there is one more indicator with respect to economy. Now why I'm discussing all these aspects is that because we'll be coming across these words: GDP, contributions, purchasing power parity, fiscal deficit, rainfall index, human development index. So today we are predominantly talking about what are the factors or what are the words that contribute towards understanding the economy. One important word that we come across most often is that purchasing power parity. Now what is it? It's a theoretical exchange rate that allows you to buy the same amount of goods and services in every country. For example, I buy a mobile in India, say for $100 of Samsung or whatever make, right? Whatever model. So this I buy in India for $100. So this I should get in the same mobile, that is one mobile, I should get same across Brazil, if I go to China, if I go to Taiwan, if I go to Japan, wherever I go, it should come only in $100, not more than that. That is what we say by allows you to buy the same amount of goods and services in every country. Right? That is for $100 converted into rupees. If I buy one mobile phone over here, the renminbi, that is the Chinese currency, or for that matter Japanese yen, or Taiwanese dollar, should be equivalent to the same amount of rupees if it is converted, that exchange rate. That is what we call it as purchasing power parity. For example, if you want to live inexpensively and you can move to any country in the world, compare prices of the McDonald's Big Mac. That is, the McDonald's that you get in US should be similarly priced in India, even if we are moving from US to India, or other way around, if you are moving from India to US. Now, why does it is necessary? Government agencies use it to compare the output of countries that use different exchange rates. Now, how do you measure the output of the countries that are using different exchange rates? Are they using fixed exchange rate mechanism or floating exchange rate mechanism? That we'll study later. So to understand or to compare the outcome of the countries that use different exchange rates, we take the help of purchasing power parity. Now, one more thing that we come across is fiscal deficit. Total expenditure minus total receipts. That means the expenditure is more as compared to receipts. That is why. Now, if we want to put it the other way, fiscal surplus will be TR minus TEE. This equation is going to shift this side. So this is what we mean to say by fiscal deficit. That is total government expenditure minus total government receipts. Generally, if you see, this thing happens in a economy which is in the growth stage, right? Now see, these are the two words that are coming across every time, and that is the reason why we had taken this earlier, these two concepts. If you want to grow, you need to spend. And if you spend more, you can spend more than your receipts by borrowing. Right? And borrowing can be done from the market or by issuing T-bills, that is treasury bills or bonds. That is how everything comes into picture. That means government wants to keep the momentum going, momentum of growth, right? It wants to keep on increasing. That is the growth rate that we come across. Say India is growing at the rate of 8.6% or 6.8% or 7%. These different agencies, they predict, that is IMF says so, UNO says so, or UNDP, United Nations says so, that India is going to grow at this rate, right? To maintain this momentum, this is what we are calling as momentum, right? Government should spend. Now, government spending means what? If government spends, there will be employment. Definitely, this is going to give rise to incomes go up, consumption goes up, consumption going up, production goes up, and distribution goes up. And economy, since it has a sustained momentum, it keeps on the growth trajectory. That's what we mean to say. Now, there's one more indicator. That's what we call it as inflation rate. Here we are talking about inflation rate. Now, what is inflation? Inflation refers to general rise in pressure measured against a standard level of purchasing power. Put it simply, means if I could buy in 10 rupees two things earlier, say in the year 2000, and if within the same things I'm not even able to buy one thing, forget about one thing, I'm able to buy a quarter of a certain thing in the year 2020. That means rupee has depreciated by 1.25%, right? That means rupee has depreciated by its value. Say 10 rupees has depreciated by 125 times. So that is what we call it as inflation rate. Earlier it was used, inflation rate was used to measure or increase in the money supply. This factor, this expansionary monetary policy would be easily understood by the students of finance, since we don't have much of time, that we'll try to discuss later. Now, inflation, how do you measure inflation? Inflation is measured by comparing two sets of goods at 2 points in time. 2 points in time, right? And computing the increase in cost not reflected by an increase in the quality. There are therefore many measures of inflation depending upon specific circumstances. Now, inflation rate gives you an idea, a backhand idea whether the economy is growing or not. Now, inflation, why does inflation set in? Is because inflation is there when more money chases few goods. So these are the equations you will not find anywhere, right? This is what we call it as inflation. More money chasing few goods. That's what we call it as inflation. Now this rate means, now when are you going to get more money? You're going to get more money when people are in the consumption mode. And when will be people in the consumption mode? When the per capita income rises. When does per capita income rise? When there is employment. When is there going to be employment? When is there investment? When are going to be investments? When the government, when the environment, economic environment is conducive. This is how everything is related. Now, let us come back to a very important concept in economics. That is interest rates, savings, loans and inflation. The interest rate determines the price of holding or loaning money. This is with respect to what are interest rates. Now we are talking about interest rates in terms of economy. Now, what is the purpose of bank? Bank's purpose is to get deposits, give loans, right? Now, when the economy is in the growth stage, means industries need money or industries want loans. Now, when there is huge demand for loans, obviously the interest rates, they firm up. You might have heard this word if you are reading the newspapers. Interest rates, the firm up. Means, firming up means the interest rates also go up. Put it simply, when the economy is growing means there is going to be a demand for money. The demand is rising. When the demand is rising, the interest prices, they go up. If the interest prices go up means the cost of investment or the return on investment, they also go up. Right? Now, if there is huge demand for money, interest rates firm up, suddenly it starts to affect consumption. So to ease the pressure on consumption, what does the government do? The government intervenes in the form of RBI intervening. The interest rates, they are brought down. People have money at their disposal. Now, if people are having money at their disposal, they spend and inflation sets in. This is what we call it as. So what does the RBI do? The RBI moderates. The main function of RBI is the moderating the flow of money. It should try to understand when it should intervene, at what time and why. If the economy is coming down, it needs to push money into the hands of public so that they spend. If they are spending, that means consumption goes up. Consumption goes up means production goes up. Production going up means employment goes up, investments go up, and the economy is into the growth mode. Very interesting. That's why I said economics is quite interesting, unless you understand what you're studying. So that is the reason why we are taking this lecture, to understand what are the terms that are associated with this. Okay? Now, what does this signify? Interest rates and inflation are inversely correlated, like I told you over here. Now, there is one more term that we need to understand, that is credit offtake. Credit offtake we need to understand. This word we need to understand, credit offtake. Now what is that? Simply put, when trade and industry and other sectors, now this has been put forth by Mr. Vinod Kumar Nagpal, former retired DGM Nationalized Bank. This has been taken from Quora.com. There's a question that was asked on that site, and this is what the answer is. Now, simply put, when trade and industry in the sector start using bank funds either from the existing limits sanctioned to them or by availing fresh credit limits, credit portfolio of the banks increase, which in banking parlance is what called as credit offtake. Already, credit has been extended to industries. Still, if they want more, right? Wanting more credit is what we call it as credit offtake. Simply put, there is demand for more credit because consumption is growing up. Now, why is consumption going up again? Per capita income is high. Why there is per capita income? Because there is employability. Why there is employability? Investments are there. Now, why investments are there? Interest rates are low. Why interest rates are low? Because the government policy is to go for growth. And that is the reason why there is increase in credit offtake. What are the reasons for that? That you can understand over here. And what are the results of credit offtake? That you can understand. The second point that is more important, more credit offtake is an indication that economy is recovering and purchasing power of the people is increasing, resulting in increase in demand of various products. That's what we are talking about, right? Now here, there's one more term called as balance of payment. Balance of payment definition. What's that? It is a systematic record of all economic transactions between the residents of a country and the rest of the world. It presents a classified record of all receipts on account of goods exported, services rendered, and capital received by residents, and payments made by them on account of goods imported and services received. Right? How much it is going out and how much is coming in. The difference is what we call it as balance of payment. Right? We need to understand that. Now, one more term that we need to understand. What are foreign exchange reserves? Foreign exchange reserves. Foreign exchange reserves are assets held on reserve by central bank. Here the central bank here in term we are talking is RBI. That's what we are talking about. Right? These are assets that are held as reserve by central bank in foreign currencies, more important word. To back liabilities and influence monetary policy, whatever liabilities that the government has on its own. Now, what is the one liability that the government has? The borrowings in the form of T-bills. Because of fiscal deficit, government has borrowed in the form of T-bills, bonds. Now, what are these? These are liabilities, right? So here we are talking in the example as US Federal Bank, but in our Indian case that is RBI, is Reserve Bank of India. Now, what are the key takeaways that you can understand? See here, that's what we are talking about: foreign currencies, bonds, treasury bills, and other government securities. These are the government liabilities. Okay. Now, what happens in the case of, say, there is the oil prices. Here, the oil prices means the crude oil prices. We are talking about crude oil. Now, what happens in that case? India being a country which imports, right? Which imports close to 90% of its requirements of crude oil from other countries. So whenever you import, you have to make payments in terms of dollars. Put it simply, more dollars going out of the country means you need to, the dollar needs to be backed by rupee, right? If more dollars going means what? You need to have more rupees, right? That means the government revenue is going mostly into making payments of crude oil. Whatever revenue it is generating, revenues, it is generating in the form of rupees. It is going into making payments of what? Crude oil. And that too in dollars. Now, in this case, what happens? The rupee becomes weak. In other words, rupee becoming weak means for every $1, the rupees that are required may keep on going up, and that is, more rupees are needed to buy $1. What is fixed here? This is fixed. For every dollar to go out of the country, you need to have more and more rupees. That means whatever revenues are being generated by Indian government are going into making payments of the crude oil. Now what happens in that case? If you see here in the case of consumers, that is quite written over here, you can study what happens with respect to consumers with inflation, current account, long-term incentives, alternatives, investments, economic growth. This we need to take into consideration. How it is going to have a retrospective effect on or retrograde effect on the stage and stages of the economy. Now, like I told you, if you want to, the economy opened up in the year 1991 means investments can be made by people who are other than the residents of this country. That is what we call it as foreign direct investment, foreign investments, or for that matter, foreign investments. Now here we are talking about foreign direct investment. What is it? It simply says is the net inflow of investments, capital or other, in order to acquire management control and profit sharing, or the whole ownership of an accredited company operating in the country. We keep on hearing receiving investment. We keep on hearing this word that the economy has opened up. Now, what do you mean by that? It doesn't mean that the gates of the country, they are opened up. It means we are opening up of economy means what? We are creating an ecosystem. Right? We are creating an ecosystem. Within that ecosystem means what? There is going to be openness. There is going to be flexibility. Right? Anybody can come and invest in India, and they can be the owners, and they can take the profits in dollars and go back to their own country. Since you are getting Now, what is foreign direct investments always comes in terms of dollars. So more dollars coming into the country means what? On one side, people are coming here to invest. On the other side, you want to make payments. So this payment making is taken care of by this. And apart from whatever the investments that are coming in, investments are going to generate employment. Employment is going to increase per capita income. Per capita income is going to increase consumption. Consumption increases production, distribution, and this again increases GDP. And that's how economy keeps on growing. Okay. Now, there's also a very large effect of the rainfall. If there's below rainfall, there's going to be a negative change in the income. That means people's incomes is going to come down. If there is average rainfall, it's associated with small positive income gain. Above normal rainfall, positive change in income. Right? Now, here again, this is an exception. Floods, events associated with reduced income and damages. Right? If there are floods, above average rainfall up to a certain extent, it is going to show a positive change in income. If there is more than above rainfall, that's floods, it's going to show a negative change in income. It's going to come down. So these are beautiful concepts, and fortunately I could get the images that are relevant with the indicators of economy. Now, how does stock market affect the economy? Economy per se, what effect does it have? What effect does it have on the economy? An increase in stock prices on the Sensex causes an increase in wealth. Right? People invest in shares, they get good returns. What is happening? Shareholders or the share buyers' wealth is increasing, and consequently that results in increase in consumer spending. Right? Now, it's also affected by higher prices because there are investments. Right? If there are more investments, the share prices keep on jumping. Their wealth is going to increase. They're going to increase their consumer spending, and if more consumer spending increasing, consumption relating to production, and this whole, if they are going up, means GDP keeps on going up. That's the same old story. Foreign exchange, it's a money denominated in the currency of another nation, that is rupee versus dollar, or rupee versus euro, rupee versus Chinese renminbi. These are what we call it as foreign exchange. These are the concepts you need to study. Now, gross savings and investment as percentage of GDP. Right? More savings, more money. Savings, if they go up, savings going up means what? More money with banks for disbursement, for loans, more loans, investments going up, employment goes up, per capita income goes up, consumption goes up, production goes up. Again, this leads to what? Employment grows up. Everything is related, right? So this reflects there's going to be a cap. If the domestic savings, they are growing, of course this is the other way around, the graph has come down. We can understand that in the year 2011-12, so gross domestic savings were 34.6% of the total GDP, value of GDP. The contribution of savings to GDP was 34.6. So at that point of time, even the capital that was formed, that is, capital formation means money that is required for as investments was almost equal. Here, if you see the savings, though they have slightly, there is a difference of 0.8%. Since savings have come down, the capital formation has come down. How does capital form? Like I told you here, savings are with banks, and banks, they are having more deposits, means they can loan more. Now, since the deposits have come down, the capital formation has also come down. Now, one more indicator of economy that is growing is Human Development Index. Now, what do you mean by that? There are three pillars of Human Development Index: long and healthy life, a decent standard of living, and knowledge. If any given country, if these three parameters they are increasing, it means Human Development Index is growing. Now, Human Development Index, in other words, in simple words, it's what we call it as, in general parlance, we talk about standard of living. Now, standard of living means how much percentage of population is not in the poverty area. That is, people have moved away from BPL situation, that is below poverty line, to poverty line, to standard, increased standard of living. In other words, the percentage of population living in poverty has to go up. Now, if that is growing up, means what? There can be two factors. People coming out of poverty are done by government spending. That is, how does government spend? Government gives employment through social welfare schemes, through social welfare schemes. That is, one of the example is Manrega. Just let me correct it. Right? Now, this is how the government intervenes. That is decent standard of living. This is one way of measuring that the standard of living has gone up. The other means there is more employment. Now, this type of employment is what we call it as indirect employment, and this is direct employment. Now, more employment, per capita income going, consumption going, production going, economy in the growth mode, right? So, Human Development Index is also measured by decent standard of living. Now, since people are spending, if you see the growth story of India with respect to gaining knowledge, that is, the education sector, people spending on education of children has gone up. How does it measure? If you see a lot of schools they have come, lot of higher education institutions they have come, right? Lot of private universities are coming. Now, how do they exist? They are existing because people's standard of living has gone up. In other words, Human Development Index has gone up. And since people are earning more, means people are spending more on staying healthy. Right? Now, how do you measure that? How many people are not dying at birth? That is a strong indicator of Human Development Index. So this whole scenario, the whole economy can also be studied from the perspective of Human Development Index. Now, it can also be studied by This total energy consumption, the total energy consumption that is being taken care of, total energy consumption to GDP. If you see the graph very closely, you see the graph. Now, this is a study which is being done by, very strange, US Energy Information Administration, done by people who are not connected with our consumption story. India's studies are being done by people from abroad, and we say that we don't know what to do about research or way to do research. Now, why they have done it, let us understand. If you see this has been constantly growing, energy consumption. Since energy is consumption means what? Energy is consumed by either industries or the general population. Now, energy can be in the form of fuels, fossil fuels, right? Alternative energy, solar energy, all these things, hydroelectricity, power generation, all these things. Now, why are people consuming? Because people can afford. This word is more important in economics, affordability. Now, what is affordability? Affordability, if it is gone up, means what? People's income, it has gone up. Now, why people's income has gone up? Because there is employment, in the same old story. So, if you see a slight dip in energy consumption means this reflects. Now, how do you measure, how do you indicate that economy is growing? If the energy consumption is coming down, means definitely industrial growth has slowed down. IG, that is industrial growth, has slowed down. Now, why? Now, to push this, the industrial growth, to push this, in other words, means this is slowed down because the consumption has come down. Now, to promote consumption, what does the government do? It reduces the interest rates. Now, what happens in this case? Money comes into the system, people invest, they spend, they buy, they consume, they produce, and that is how the economy, which was coming down, suddenly starts to go up. Right? Now, when it is going up, obviously, if you see from the year 2003 onwards, energy consumption has been definitely growing up, and accordingly, the GDP is also going up. Energy, GDP. Now, in a nutshell, these are all we are talking as indicators of economy. You can study economy from these different lenses. Now, why I wanted you to understand these is because we'll be talking a lot about, or you might be hearing a lot about these concepts in your everyday life. So, we are trying to make sense of whatever we are hearing. Otherwise, whatever you are hearing, whatever you are reading, if it doesn't make sense, so anything not making sense is what we call it as. So, to remove this, we are trying to understand, and to understand that, fortunately, very fortunately, that I could gather all these images that you are seeing. Very lucidly, this has been possible for me to explain the different indicators of the leading indicators of the economy. Thank you. That's all for now. Thank you.